Hey Bowtie Nation, Joseph Hogue here, and I see a lot of investors losing money buying the dip in stocks, a strategy that might have worked in the past but is now totally broken. So I wanted to put together a quick video explaining why the dip is busted right now and what to do instead. Now most investors think buying the dip just means whenever stocks go down, you buy more, kind of a vague idea of picking up stocks at a discount. There is actually an official strategy though that has tracked returns. In data from Dow Jones, we see the week after returns here if you bought stocks after a one-day decline of 1% or more. So if you bought the dip anytime stocks went down by 1% or more in a single day, these are the average weekly returns you would have made during each year. And historically, it's been a great strategy all the way back to 1930. Most of these years, you would have averaged between 0.5% to 1% return in the week after that market dip. In fact, the last year in the graph here is just last year, 2021, when buying the dip would have meant an average return of 2% in a single week. But 2022 has been anything but normal and less than nice to investors, and the buy the dip strategy is broken. This is what the strategy looks like this year, the worst buy the dip market since the Great Depression of 1931. Buying after a 1% drop this year would have lost another 1.2% in the following week. The S&P 500, the 500 largest companies in the United States, the benchmark for all stocks, is down 23% so far this year, on track for the worst annual drop since 2008. And that crash is only getting worse. Stocks got crushed when the Fed raised rates by 0.75% last month to a range as high as 3.25%. This is the Fed Watch tool on the CME Group website and shows the market expects the Fed to raise rates by another 1.5% by February. Nation, what do you think that is going to do to the economy and to stocks? Inflation is not slowing down fast enough. Consumers are about to get slammed by winter utility bills that will be 30% higher over the last year. And investors have yet to embrace the horror that a recession is unavoidable. Now, despite all this, though, a lot of investors continue to buy the dip, pushing money into the market after every single drop. According to Vanda Research, on September 13th, when the S&P 500 crashed 4.3% in its worst day since 2020, individual investors bought more than $2 billion in stocks and ETFs. Now, that was the second highest single-day total of the year. Investors piled into that spider S&P 500 ETF, the SPY, to the tune of $395 million alone. Since that day, the SPY is down another 7.7% and shows no signs of a bottom. Buy the dip is clearly unredeemably broken, so I want to give you another strategy for stocks. First though, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, don't get me wrong here, folks. I still want you to keep saving and investing, putting that money regularly into your investing account. I see too many investors see stocks fall, they get frustrated by losses, and they just stop saving. But nation, here's the problem. When you stop saving money, your expenses just magically rise to meet whatever amount you have in your bank account. I don't know if it's keeping up with the Joneses, voodoo, or just the fact that Starbucks has found yet another way to help me blow my diet, but people are horrible at saving money. And what happens is when stocks do recover and you want to start investing again, it makes it all the harder to start saving money. So keep that habit of saving and putting money in your account. But now, just because you have that cash in your account does not mean you have to buy stocks or jump in after every dip. And that is where this smart investing strategy comes in. Because instead of buying every dip, you're going to hold that cash and set 3 levels in the S&P 500. 3 levels you can watch for to put some of that cash to work. For example, I have about 25 to 30% of my portfolio already in cash, building it up this year as well as selling some of the stocks last year. With the S&P 500 just under 3,700 after having topped out at 48.18 in January, I'm watching for 3,500, then 3,150, and then 3,000 on that index for when I start putting some of that money to work back in stocks. Now, I'll explain what I'm doing at each of these levels and how I picked them, but most investors just don't realize how powerful having this kind of a strategy is for their returns and their sanity. You see too many investors lose their mind watching the market every single day, wondering if each drop in stocks is now the time to buy. They stress out every day and end up buying the dip, jumping in on that fear of missing out, and in a year like this, end up losing a lot of money. Not only will the strategy I'm about to show you help you put some of your money back to work while also keeping some of it back if stocks fall further, basically giving you the best of both worlds, it's also going to help you keep from getting stressed out about stocks every single day. You are going to have a strategy, and you don't have to worry about when to invest. So here, if the S&P 500 hits each of these three levels, I'll invest a third of my cash in my favorite stocks. For example, if I had $100,000 in cash and that broad market index continues to drop to 3,500, I'm going to take about 33,000 of that, or about a third of that cash, and buy stocks in my portfolio. Now here I'm only using the S&P 500 as that trigger. I'm not investing in the index, but instead buying the dip in many of the stocks I already own. You can buy the market with an ETF or your favorite stocks, whichever works best for you. But then, if the market continues to fall and triggers those other two levels at 3,150 and 3,000, that's when I put the rest of my cash to work. And nation, these aren't just some arbitrary numbers I pulled out of my ass. 3,500 on the S&P index would be about 27% from those all-time highs in January, and right around the average for bear markets over the last 50 years. Now, I don't think the crash would be over though, so I'm going to keep some cash back for that 3,150, which would be down about 35% from the peak, about the same as that 2020 crash that saw stocks fall 35% in 1 month. Finally, an index level of 3,000 would be about 38% from the high, and more importantly, 15 times my estimate for 2023 earnings for companies in the S&P 500. You see here from FactSet that analysts expect companies in the S&P 500 to earn a total of $226 per share this year. That's the second bar from the right. And then to earn $243 per share next year. But there is no way in hell those 500 companies post $243 in earnings next year, not with the recession that's coming. This chart from research by Deloitte shows the average drop in earnings from a recession. Back to 1948, U.S. corporate profits have taken a 10 to 20% hit from the year before in a recession. That means even in what could be a mild recession would see earnings fall 10%. So instead of the S&P 500 earnings growing from $226 this year to $243 per share next year, my estimate is they could fall to $203 per share when the Fed hikes and that drop in consumer spending just sets in. Another chart here by FactSet shows the price to earnings ratio over the last 10 years. So that price of the S&P 500 divided by the earnings of all the stocks in that broad market group. We see the blue dashed line, that 10-year average PE ratio just above 20 times, and stocks where they are now 19 times, which isn't expensive but isn't cheap either. Here I've drawn another line, 15 times on that price to earnings ratio has historically been a great place to buy, even going back decades. So then if we put these two ideas together, my estimate for about $200 in per share earnings next year for the companies in the S&P 500 and that target of 15 times on the price to earnings basis. So 15 times 200 equals a target of 3,000 on the S&P 500. It is at that point that stocks would be an undeniable bargain. Now, nation, I'm not saying that stocks are going to stop at 3,000, and there's no guarantee they'll even drop that far in the first place. The last two real market crashes have taken stocks down 50%, which would mean 2,400 on the S&P 500 index, and a whole lot more pain from here. What I am saying with this strategy is I would be happy to get in on stocks at 37% down from that top and at that valuation of 15 times earnings. I can take a little bit more pain from there because I know that long-term return is going to be excellent as stocks eventually stampede into the next bull market. Click on the video to the right for the 7 dividend stocks that will make your car payment. 7 cars and 7 stocks that put you in the driver's seat. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.